Good day! We are the Group 9 and we are tasked to discuss the cost and break-even analysis. My name is Queenie and my partner is Doris Diane, and I am going to discuss to you the different types of cost concepts. So let's start. Cost concepts. So costs play a very important role in managerial decisions, especially when a selection between alternative courses of action is required. It helps in specifying various alternatives in terms of their quantitative values. So the following are various types of cost concepts. We have future and past costs, incremental and sunk costs, out-of-pocket and book costs. In addition, we also have replacement and historical costs, explicit costs and implicit costs, actual costs and opportunity costs. Also, direct costs and indirect costs, fixed costs, and variable costs. And of course, short-run costs and long-run costs. So, let's discuss them one by one. Future costs. Future costs are those costs that are likely to be incurred in future periods. Since the future is uncertain, these costs have to be estimated and cannot be expected to absolute correct figures. For example, when a business is determining its budget for a future time frame, an estimate of the future costs of necessary items is typically included. So in other words, future cost is an estimated quantification amount of a prospective expenditure. Past costs. Past costs are actual costs which were incurred on the past and they are documented essentially for record-keeping activity. The past cost is money that has already been spent, so these funds cannot be recovered, so the related cost is irrelevant for decision-making purposes. A past cost is also known as a sunk cost. Incremental costs. Incremental cost is the amount of money it would cost a company to make an additional unit of product. So let's watch the video for further knowledge.
Incremental cost is the added cost of manufacturing one more unit. Also called marginal cost, it's the cost a company incurs when it makes one more unit. These costs would not exist if production did not increase. Suppose a company, Joe's Skateboards, makes 100 skateboards per week at a cost of $1,000, including employee wages, material, and electricity costs. Joe's employees make an additional skateboard one week. Its incremental cost is $5, mostly from material because Joe's employees did not work extra time to get the job done. Incremental costs are usually lower than a unit's average cost to produce. Incremental costs are always comprised of variable costs. These costs might come from materials, utilities, wages, shipping, packaging, or any number of variables. Understanding incremental costs can help a business improve its efficiency and save money. Incremental costs may change when workforces are reduced or a product is no longer produced, perhaps revealing ways to cut costs.
Sunk costs. Sunk costs are those which have already been incurred and which are unrecoverable. In business, sunk costs are typically not included in consideration when making future decisions, as they are seen as irrelevant to current and future budgetary concerns. Let's watch another video.
A sunk cost was incurred in the past, is independent of future events, and cannot be recouped. Economists teach that sunk costs should not be considered when making a financial decision. Rather, decision makers should only consider future costs. For instance, Crude Oil Inc. has spent $30 million drilling an oil well that has not yet hit oil. The chance of striking oil keeps diminishing as the well gets deeper. Crude Oil has $20 million more in funds. It still might strike oil in the current well, so it can use those funds to complete that well. Alternatively, it can use the $20 million to drill another well in a new location with a slightly higher probability of finding finding oil. The decision to continue with the existing well or drill a new one should be based on the probability of hitting oil in the existing well versus the new location. The $30 million initially spent is a sunk cost and is irrelevant. Whether or not crude oil strikes oil in the new well or the old well, the fact that they already spent $30 million does not change. Since there is a greater chance of striking oil in the new location, economists would recommend this as the better alternative. If crude oil managers choose to continue with the existing well, economists would refer to that decision as loss aversion. The managers are averse to giving up the sunk costs and thus choose to continue to spend more money on the less lucrative project.
Out-of-pocket costs. Reimbursable out-of-pocket costs are things you pay for with your own money, then someone pays you back for them. So reimbursable out-of-pocket costs can also occur when traveling. Some companies opt not to pay for alcoholic beverages, so therefore, this reimbursable out-of-pocket cost is a matter of company policy. Book costs. Example of book costs are capitalized costs, which are incurred when building or purchasing fixed assets. Capitalized costs are not expensed in the period they were incurred, but recognized over a period of time via depreciation or amortization. Let's watch the video.
A capitalized cost is an expense associated with a fixed asset that is added to the basis of that asset and expensed over the depreciable life of the asset. In the short term, some expenses are capitalized in one accounting period so they can be expensed in total in the next period. Costs are capitalized due to the matching principle of accounting, which states that expenses should be matched to the same periods they are used to earn revenue. In the longer term, capitalized costs are added to the depreciable basis of an asset. This usually occurs with large construction projects. The cost to build the facility will include the raw material used to make it, the construction labor costs, interest on any loans used to pay for building the facility, transportation costs incurred to ship materials to the construction site, and any sales taxes incurred on purchased materials. All these costs will be included in the costs of the production facility, which will be used for at least the next 30 years. Rather than deducting these costs in the year the facility is constructed, they are expensed through depreciation over the next 30 years. This is a better matching of those expenses against the revenue generated by the production facility.
Replacement costs. Replacement cost states the cost that the firm would have to incur if it wants to replace or acquire the same asset now. Let's watch the video.
The replacement cost is the cost you'd have to pay to replace an asset with a similar asset at the present time and value. For example, say that you buy a brand new set of drums for $1,000. They're the best brand and style of drums currently made. After you've owned them for about a year, you return home from work one day and find they've been stolen. A year later, that same brand and style of drums now sells for $1,100. Your replacement cost is $1,100. Companies can buy replacement cost insurance to protect their assets. The assets companies typically want to protect with such insurance include buildings, stocks, accounts receivables, or liens. Values will change depending on changes in market value. The gradual depreciation of an asset's value is not a consideration. A replacement cost is usually higher than an item's current value, but that does not always matter to the insurance company. Say a delivery company has one of its trucks destroyed in an accident. It paid $10,000 for that truck 2 years ago. That same brand of truck now sells for $12,000. If there's a truck on the market that has the same capabilities as the old truck and it costs $9,000, the insurance company might only pay for the $9,000 truck.
Historical costs. Historical cost of an asset states the cost of plant, equipment, and materials at a price paid originally for them. Let's watch the video.
Historical cost equals the original purchase price of an asset recorded on a company's balance sheet. This is the required method in the United States under Generally Accepted Accounting Principles, GAAP. Historical cost represents the purchase price, but it can also include any costs incurred to make the asset part of the company's operating assets. Assume ABC Corp. Purchased a machine for $50,000. ABC also paid an additional $2,000 for delivery and $3,000 for installation. So in addition to the $50,000 purchase price, the historical cost of the machine includes $5,000 for delivery and installation for a total of $55,000. This will be the number used by the company for depreciation calculations. Often the historical cost does not reflect current fair market value. For instance, a tangible asset could be a factory the company purchased 50 years ago. The factory may be fully depreciated on the company's books, even though it may be sitting on very valuable land. There are exceptions to the historical cost rule. For instance, marketable securities are listed on the balance sheet at their fair market value. In addition, impaired assets are not listed at their historical cost. An impaired asset's fair market value is less than the historical cost, or book value, of that asset.
Explicit costs. Explicit costs are those expenses which are actually paid by the firm. These costs appear in the accounting records of the firm. Let's watch the video.
In business, explicit costs are easy to identify and account for. Common examples of explicit costs include wages, utilities, rent, raw materials, and other direct expenses companies pay to conduct business. Explicit costs play pivotal roles in determining a business's strategy. For instance, Jim's Furniture Company makes wooden cabinets and knows the coming year is likely to see a rise in the cost of raw materials. That includes the lumber Jim's must buy to build its merchandise. Determining how to pay that added explicit cost is a crucial part of a company's business strategy. Explicit costs differ from implicit costs, which are costs that stem from the opportunities a business loses due to the way it allocates resources. For example, the time Jim spends searching for new lumber suppliers instead of expanding his company's offerings is an implicit cost of running his business. It's not as tangible as explicit costs, but it's still important. Explicit costs are cash outflows that are easy to track. They provide a clear impact on profits and a company's bottom line.
Implicit costs. On the other hand, implicit costs are theoretical costs in the sense that they go unrecognized by the accounting system. Let's watch the video.
An implicit cost is any cost associated with not taking a certain action. If XYZ company has limited resources and chooses to develop product A instead of product B, then later finds out that product B would have been more profitable, the implicit cost of this decision is the missed profits from not developing and selling product B. Implicit cost is often difficult to quantify. This is in contrast to explicit cost, which can always be quantified because it involves a transaction tied to an exchange of cash at some point. From an economist's perspective, total economic profit includes both explicit and implicit costs. Alex has been operating her burger shop for 50 years at the same location. She purchased the land and building for $1,000. Over the years, the area where Alex operates has grown. Alex's burger shop now sits on some of the most valuable property in the city. If Alex rented her land, she could make $120,000 per year. Instead, Alex keeps flipping burgers and earning about $70,000 a year in profit. An accountant will say that Alex's business is profitable because of the $70,000. An economist will add the implicit cost of $120,000 to the profit calculation and say Alex has an economic loss of $50,000.
Actual costs. Actual cost means the actual expenditure incurred for producing a good or service. These costs are the costs that are generally recorded in account books. For example, we have actual wage paid or the cost of material purchased. Opportunity costs. It refers to the cost that is forgone or lost when one action is taken over the next best alternative cost of action. Let's watch the video.
Opportunity cost is what a person sacrifices when they choose one option over another. Tony is a sous chef at one of the best restaurants in the city. He earns a respectable salary of $50,000 a year. It's a good job, but he thinks he can do better. So he decides to start his own restaurant called Tony's Bistro. In the first year, he earns only 25% of what he made as a sous chef, or $12,500. The opportunity cost of starting his own business is the other 75% of the income that he would have made if he had stayed at his old job, or $37,500. Tony doesn't make too much for the first 4 years his restaurant is open, and his opportunity costs are high. He only earns $50,000 instead of the $200,000 he would have earned at his old job. So his opportunity cost is $150,000. Suddenly, in year 5, Tony's Bistro starts receiving rave reviews from food critics and earning top rankings from Zagat and Michelin. Business is booming, and he is making 5 times as much as he made at his old job, or $250,000 a year. He realizes that if he was still working as a sous chef, his opportunity cost would now be $200,000 a year. Although Tony sacrificed income and his opportunity cost was high in the short term, in the long run, his opportunity cost would have been higher if he had not opened his own restaurant.
Direct costs. There are some costs which can be directly attributed to the production of a unit for a given product, and these costs are called direct costs. Let's watch the video.
Direct costs for finished goods refer to the items and services directly used in production. Other costs, such as rent and insurance for the production site, are indirect costs. These costs may be allocated to the cost of the finished good, but they are not direct costs because they do not vary with production levels. ABC Corp produces widgets. The cost of labor to manufacture one widget is 50 cents. The cost of the raw materials is 25 cents per widget. ABC's monthly rent payment for its widget factory is $30,000, and monthly insurance on the widget factory is $4,000. Assume ABC made 100,000 widgets in the month. The total direct cost per widget is as follows. Labor, 50 cents. Raw materials, 25 cents. Total direct cost divided by widget, 75 cents. Note that the cost per unit for indirect costs would vary as the number of produced widgets changes, whereas the direct cost per unit would not. If ABC produces 200,000 widgets in the month, rent and insurance cost per unit would drop.
Indirect costs. So on the other hand, costs which cannot be separated and clearly attributed to individual units of production are classified as indirect costs. Examples of indirect costs are production supervision salaries, quality control costs, insurance, and depreciation. Fixed costs. Fixed costs are expenses that have to be paid by a company, independent of any business activity. It is one of the 2 components of the total cost of goods or service, along with variable costs. Examples include rent, buildings, machinery, etc. Let's watch the video.
Fixed costs are business expenses that do not change as the level of production goes up or down. They are one of 2 types of business expense, the other being variable costs. Variable costs do change as the volume of production changes. For example, a lease on a building is a fixed cost because the monthly rent is the same regardless of production. Raw material costs, on the other hand, are variable costs because increasing or decreasing production requires an immediate change in raw materials. Fixed costs are the key to achieving economies of scale, meaning a company makes more profit per unit as it produces more units. For example, Marcel's Monster Bikes has a lease for $50,000 per month. If it produces 5,000 bicycles, the cost of the lease is spread over 5,000 units, or $10 per bicycle. If the company sells 10,000 bicycles, it spreads the fixed cost of the lease over more bicycles. The cost of the lease is now $5 per bicycle. Marcel's Monster Bikes now has lower cost and higher profit per bicycle by producing more units while keeping some costs fixed. This is economies of scale. Note that fixed costs are only fixed over a certain range of production volume. When production increases far enough, fixed costs generally must be increased. For example, if Marcel's Monster Bikes sells 100,000 bicycles, it will likely have to lease another building and hire more managers, raising its fixed costs.
Variable costs. Variable costs are corporate expenses that vary in direct proportion to the quantity of output. Unlike fixed costs, which remain constant regardless of output, variable costs are a direct function of production volume, rising whenever production expands and falling whenever it contracts. So for examples, the examples of common variable costs include raw materials, packaging, and labor directly involved in a company's manufacturing process. Let's watch the video.
Variable costs vary depending on a company's production volume. Variable costs go up when a company produces more goods or services and go down when it produces fewer goods or services. This is compared to fixed costs, which do not change in proportion to production volume. For example, BA Donuts Incorporated produces donuts and pastries on a daily basis using raw materials like sugar, flour, milk, and eggs. It also needs to pay for the production facility, insurance for the storage unit, security surveillance, and equipment. The variable costs BA Donuts needs to pay are sugar, flour, milk, eggs, and any other material they must use to produce donuts. The more they produce donuts, the more they will have to pay for raw materials, but the less they make donuts, the less they'll have to pay for raw materials. The cost of the production facility, insurance, security surveillance, and the equipment are all considered fixed costs because regardless of production volume, those expenses need to be paid. Variable costs are important because management needs to know its variable and fixed costs to see how profitable the company will be if they produce more or less. Investors and analysts usually consider companies with a high ratio of variable costs to fixed costs to be a safer investment, as their profit margin is less volatile and profitability and risk is easier to take into account based on a production basis.
Short-run costs. The short run is a concept that states that within a certain period in the future, at least one input is fixed while others are variable. In economics, it expresses the idea that an economy behaves differently depending on the length of time it has to react to certain stimuli. Let's watch the video.
Short run is the concept that for a business, at least one factor of production is fixed, while others are variable. The short run is a length of time during which fixed conditions cannot be altered, and certain decisions cannot be changed to increase production. It's not a definitive period of time, but rather a period that lasts as long as the business's contracts do. In the short run, a business can increase output by changing certain variables that are not fixed, such as raw materials. For example, a business that builds bicycles is making short-run decisions based on the fact that its current lease expires in 3 years. The lease is a fixed cost that must be paid. To increase production, it has decided to increase its workers' hours and buy more raw materials. In the long run, the business's owners want to build a new manufacturing plant that can help them increase production and revenue. Long-run planning offers the flexibility to make arrangements that will better serve the company's needs in the future. But in the short run, it will continue to operate out of its current location. In some situations, it's better to operate amidst unfavorable circumstances in the short run if it will help offset fixed costs. In the long run, an unprofitable company can replace unfavorable contracts with deals that help it profit. Companies that manage short-run costs well are more likely to succeed in reaching their long-term goals.
Long-run costs. The long run is a period of time in which all factors of production and costs are variable. In the long run, firms are able to adjust all costs, whereas in the short run, firms are only able to influence prices through adjustments made to production levels. Additionally, while a firm may be a monopoly in the short term, they may expect competition in the long run. Let's watch the video.
A long run is a period of time in which all factors of a business's production and costs are variable. In the long run, companies can adjust all costs. It's not a set period of time, but rather the time horizon needed for a producer to have flexibility over all production decisions. In the short run, at least one production factor is fixed, so companies can only influence prices through adjustments made to production levels. For example, ABC bicycle manufacturer wants to construct a bigger plant to increase production and revenue. Making the necessary arrangements to build the plant uses long-run planning. In the short run, ABC still wants to increase production. But since its current lease doesn't expire for 3 years, its options to make more bikes include buying more raw materials and increasing workers' hours. As ABC begins making plans for its larger plant, new competitors might enter the field. Other competitors may leave because they don't think the industry's future is bright. In the short run, barriers to entry prevent competitors from quickly entering or exiting the business. Firms looking at the long run understand they cannot change production levels to achieve a state of equilibrium between supply and demand. They can either expand or reduce production, or enter or exit an industry based on the profits they think they'll earn.
Thank you so much for listening, and I hope you learned something on the topic. Now, let's go and discuss the concept of break-even analysis.
Hi everyone, I am Doris Dayan Patenya and I will be reporting the contribution and break-even analysis. Now after learning the cost concepts, we will get to learn what is break-even analysis. But before I discuss further the topic, I'd like to show you this quick video summary of break-even. Let's all watch this.
Break-even and cost volume profit analysis explained in 3 minutes. When can you say a business is good or not? Quite simply, it's good if the money earned is more than the money spent. However, a business has to spend on long-term stuff and short-term stuff. For example, if your business spends on a new shop, this is a long-term thing. If it spends on the cost of lemons because you're selling lemonade in a lemonade shop, this is a short-term thing. When we say that a company breaks even, we are generally only comparing money earned against the short-term stuff, like the ingredients which go into your lemonade, the salary you might pay to your lemonade maker and shop manager, the insurance and rent for your shop, advertising of your lemonade, taxes for your business, and other similar things. When you earn enough from selling lemonades to pay for these short-term things, we may say that a company has reached its break-even point. When you're not selling enough lemonades and not earning enough to pay for these short-term things, your business is said to be losing money. When you're selling more than enough lemonades to earn more than enough money to pay for these short-term things, this extra earnings is called profit. So when you're at break-even point, you're not in a good situation, but you're also not in a bad situation. You have no profit, but also no loss. If you're still starting out in your business, you of course want to target reaching break-even point so that you don't lose money. Break-even analysis is when we try to find out how much sales we need so that your business can break even. But after a while, you'll want to do better than break even. You'll want to have some profit as well. So when we try to find out how much sales we need to be profitable, do we still call this break-even analysis? Normally, no. We now call this cost volume profit analysis, or CVP for short. With cost volume profit analysis, we try to find out how much sales we need to reach a certain target profit. So anyway, that's the super simplified explanation of break-even and cost volume profit analysis. Would you like to learn how to calculate break-even point the easy way? Check out my free video at mbabullshit.com. See you there.
Now the video actually summarizes what the topic is all about, the break-even analysis. Break-even analysis is a very important aspect of business plan. It helps the business in determining the cost structure and amount of sales to be done to earn profit. It is the level of sales volume where total revenue and total expenses equal. That is, there is neither profit nor loss, meaning walay lugi, walay ginansya. Now let's take a quick review of the key terms as discussed by the previous reporter. Variable cost are costs that change with changes in production levels or sales. For example, cost of materials used in production of the goods. Fixed cost remains roughly the same regardless of sales output or level. For example, rent, insurance, and wages. Unit price is the amount of money charged to the customer for each unit of a product or service. Total cost is the sum of the fixed cost and variable cost for the given level of production. That is, fixed cost plus total variable cost. The total variable cost is the product of expected unit sales and variable unit cost. That is, expected unit sales times variable unit cost. Total revenue is the product of expected unit sales and unit price. That is, expected unit sales times the unit price. Profit or loss is the monetary gain or loss resulting from the revenues after subtracting all associated costs. That is, total revenue minus total cost. Now, based on the video shown earlier, we have learned that break-even analysis chart is a graphical representation of cost at various levels of activity. With this, business managers are able to ascertain the period when there is neither profit nor loss made for the organization. This is commonly known as the break-even point.
Let us examine this graph. The number of units is on the x-axis, or horizontal, and the dollar amount is on the y-axis, or vertical. The red line represents the total fixed cost of $100,000. The blue line represents revenue per unit sold. For example, selling 10,000 units would generate 10,000 times 12 equals 120,000 in revenue. The yellow line represents total cost, fixed and variable cost. For example, if the company sells 0 units, then the company would incur 0 in variable cost, but 100,000 in fixed cost, for a total cost of 100,000. If the company sells 10,000 units, the company would incur 10,000 times 2 equals 20,000 in variable cost and 100,000 in fixed cost, for a total cost of 120,000. Per representation, the break-even point is at 10,000 units. At this point, revenue would be 10,000 times 12 equals 120,000, and cost would be 10,000 times 2 is equal to 20,000 in variable cost and 100,000 in fixed cost. When the number of units exceeds 10,000, the company would be making a profit on the units sold. Note that the blue revenue line is greater than the yellow total cost line after 10,000 units are produced. Likewise, if the number of units is below 10,000, the company would be incurring a loss. From 0 to 9,999 units, the total cost line is above the revenue line. Now I would like to reiterate what the video presented earlier, that when you are at break-even point, you're not in a good situation, but you're also not in a bad situation. You have no profit, but no loss. Of course, we want to get break-even point so that we don't lose money. So break-even analysis is when we try to find out how much sales we need so that the business can break even. Contribution margin is equal to the difference between total sales and total variable cost. Or in other words, it is the amount by which sales exceeds total variable cost. In order to make profit, the contribution margin of a business must exceed the total fixed cost. In short, sales minus variable cost equals contribution margin.
Now, how do we compute contribution margin? That is, unit selling price minus variable cost equals the contribution margin per unit. Let's say we have 100,000 as unit selling price and we have 60,000 as unit variable cost. The unit contribution margin would be 40,000. Given the contribution margin per unit, we now compute the contribution margin ratio. Contribution margin ratio is contribution margin per unit divided by the sales. Contribution margin per unit of 40,000 divided by 100,000 selling price equals 40% contribution margin ratio. Now let's have an illustrative problem. The Don Company. Selling price of 20 per unit, variable cost of 14 per unit, fixed cost of 792,000, and desired profit of 60,000. How do we compute break-even in units? The formula is total fixed cost divided by the contribution margin per unit. So if we have a total of 792,000 fixed cost, we divide it by 6 pesos. We now arrive with 132,000 units break even. Now, how do we compute the break even in peso? The total fixed cost will be divided by the contribution margin percentage, or ratio. Now let's have an illustrative problem. The Don Company. Selling price of 20 per unit, variable cost of 14 per unit, fixed cost of 792,000, and desired profit of 60,000. If we have 792,000 fixed cost, we divide it by 30% contribution margin ratio. Then we will arrive with 2,640,000 break even in peso. Break even analysis is an important aspect of good business plan, since it helps the business determine the cost structure and the number of units that needs to be sold in order to cover the cost or make a profit. I hope you learned something new today. Thank you for watching.